Welcome and thank you for taking part in the advisory group's Pyramid of Success video series. As you transition into adulthood, or you're getting your career underway, or perhaps you're in a pivotal time where you need to look carefully at what the future holds, we feel that the tips and techniques we will cover here can help set the stage for you to work towards reaching financial success. And we have created a series of 4 videos, each designed to assist you with understanding an important facet of the things that we believe you need to know to make your life easier and more successful. And we highly recommend that you view all 4 videos. So let me first start with some introductions. My name is Manny and I'm a senior wealth advisor with the advisory group. Also joining me is Brent Beverly, the president of the advisory group, and Chris Lee, the vice president of the advisory group. All 3 of us are certified financial planner practitioners. Now, before we begin, it is always important to review that there are 5 key areas of financial planning. These are protection planning, retirement planning, tax planning, investment planning, and estate planning. As a comprehensive financial planning services firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. During this series of presentations, we will be covering the 4 areas you see highlighted on your screen: retirement planning, tax planning, as well as investment planning and estate planning. There are 4 separate videos that we have prepared, one for each of these subjects. Again, please be sure to watch all 4 videos. Let's talk first about the structure for your planning. This is what we refer to in our organization as a tag pyramid. It represents a structure with different levels of priority to address and to potentially seek. At the very bottom is your foundation. This includes the items you need to have in place and that we encourage you to satisfy. The estate documents such as the wills and the healthcare directives, your insurance policies to protect your loved ones and hard-earned assets, and your home. Next up are your reserves, your emergency funds that you have to keep on hand, likely at the bank, for immediate access should the unexpected and costly arise. This level of liquidity sacrifices potential growth, which again is why it can't be at too high of a level. Next up are your income-producing investment assets. These are considered lower risk than equity assets because they would have a fixed rate of return. These require your investment dollars but have rates of return that aren't going to experience significant growth. Following this are growth and income-oriented investments. Now you're taking on more risk by investing in equities and exposing yourself to the ups and downs of the stock market. Here you may be investing in companies that have the potential to grow at an above average rate, or those that pay out dividends but aren't going to experience significant growth. You then have growth investments. You're at a riskier level with your stock exposure, made up of the growth investments we talked about in the previous level, and now potentially adding international stocks with room to grow. And finally, we have the exotic level. This is one where we will not provide much guidance. Collectibles, precious metals, lottery tickets, cryptocurrencies, they may be all nice and fun to own and cross your fingers on, but we simply will not structure them into a financial plan or depend on them. Investments can be complicated, but let's work to keep the concept simple. For many years, investments were divided into just 3 asset classes: cash, bonds, and stocks. Now, cash is pretty easy to understand. In addition to the cash in your wallet, we include the money you have at the bank. The goals here are liquidity, which means being able to use the money quickly and easily, as well as safety of principal. Money in the bank has Federal Deposit Insurance Corporation, or FDIC insurance on it, providing a guarantee of your money up to a certain level. Bonds are investments where you lend money, typically to a government or a company. Included in the bond are important details, such as how much interest they will pay you and when they will pay you the interest payments, as well as when will they pay your investment back. The term for that payback is the maturity date. And it's important to know to whom you are lending your money and what is the source of the repayment to you. Stocks, on the other hand, represent ownership in a company. This ownership is represented in shares. If you own part of a company, the value someone is willing to pay you for your ownership will depend on the prospects for that company to make money. For example, if Amazon's prospects go up, you would expect their stock price to go up accordingly. If Amazon faces issues, you would expect their stock price to go down. Now let's talk a little bit about risk. Many investors focus on risk solely representing the susceptibility of an investment to drop in market value in the short term. If a stock can go down in price 30% in a month, that is indeed a risky stock. But there are also risks involved with not providing your hard-earned assets some growth opportunity. You see cash down there at the bottom, good old cash. It is considered the least volatile and thus regarded as the least risky vehicle in terms of value fluctuation. And with FDIC insurance, the government will even step in and make you whole up to a certain level should the banking institution fail. But cash does present another risk, purchasing power risk. If you keep an excess level of cash sitting on the sidelines for a long period of time without the need to access it, you are likely to be eroding its purchasing power. We will address inflation in more depth in a couple of slides. Let's say this a different way. We divide the thousands of investments into two fundamental classifications. The first is loanership. When you put your money into a bank, for example, you are loaning your money to the bank. If you buy bonds, you are loaning your money to a company or government. This is what we refer to as loanership money. On our previous slide, you saw cash and bonds, with cash having much lower volatility and lower expected long-term returns. Bonds showed as having more volatility but more expected long-term returns. Anytime you loan money to someone, the biggest concern is typically, will I get my money back? So far, I think I am running at 100% of us who loaned money to someone in high school and never got paid back. This is why bank accounts are so popular. We have FDIC insurance to make sure that we get our money back. So what is the price you pay for security? Typically, it is that you get lower returns in the long run. Now, taxes and inflation affect your real rate of return. To get additional information on how to use taxes to your advantage, please check out the video in this series on taxes. Especially when dealing with cash or loanership dollars, you start with your top line rate of return. We're going to use round numbers for simplicity, but let's say you open a high yield savings account paying 1% interest. We know that seems really small, but these days that is a higher return of interest than you are probably actually earning on the checking account at your bank. You still have to pay taxes on that 1%, as small as it may seem. So we're going to use a 24% bracket to take away from that 1% earning, which leaves you with a 0.76% after-tax rate of return. To use real dollars, if you invest $10,000 into the savings account at 1%, you get $100 a year of interest. And if you are in the 24% tax bracket, that $100 results in a tax bill of $24, leaving you with $76 after all is said and done. Next, we take into account the inflation rate. This goes back to our earlier slide where we mentioned cash being subject to purchasing power or inflation risk. Those funds sitting in the bank earning 1% are unlikely to have the same purchasing power with each month that passes, more so during these high inflationary times. And we have seen recent inflation of over 8%. But for this exercise, we'll use a more moderate inflation rate of 3%. And when you subtract that taxation and inflation, you get the real rate of return. So in the end, after factoring in taxes and inflation, your 1% rate of return actually netted you a negative 2.24% real rate of return. These days, it's likely even lower. And just for the record, these terms that we are using, such as real rate of return, are not my personal terms or the advisory group terms. They are economic terms recognized around the world. So when you do this calculation using bank accounts and short-term bonds, almost always your real rate of return is going to be negative. This is what we call going broke safely. And this is the concern we have with having too much of your funds being held in cash. Because after taxes and inflation, cash typically loses spending value over time. So when we talk about risk as far as investing goes, risk surely takes multiple forms. So how do you beat taxes and inflation with your investments? What has delivered returns above taxes and inflation for generations has been what we call ownership investments. Investments such as stocks or real estate. One of the most popular methods of ownership is owning stocks in the stock markets. What is the problem with owning stocks in the stock market? The market goes up and down. Now over time, the stock markets have trended up enough to beat taxes and inflation. There is no guarantee, of course, and past performance does not predict future performance. You will hear us refer to the up and down movements in the stock markets as volatility. In our first chart on investment basics, we noted that stocks have higher volatility than cash or bonds, but also have higher expected long-term returns. When we talk about the ownership investments, we know that they come with volatility. That means that ownership investments, especially stocks, go up and they go down. Our focus for a long-term plan is how they perform long-term from point A to point B, again realizing that there will likely be big fluctuations along the way. It is not meant to be a smooth, comfortable ride, but they provide the biggest opportunity for long-term growth. The biggest difficulty with long-term investing in these volatile investments is that as they go through their cycles of ups and downs, our emotions make us do the wrong things at the wrong times. We see many investors experience disappointing returns because they have an emotional, undisciplined approach to investing. And what we have in this chart is a typical emotional cycle as it relates to investing. As you begin to invest, you're fearful, perhaps of past recessions or down markets, and the thought of losing every dollar that you're investing. However, your investment rises and you begin to feel hopeful and optimistic that your investment is going to rise even higher, and sure enough, it does. You're then feeling greedy and think there's no stopping this investment, and so you buy and you buy big. As the market continues to advance, greed inevitably sets in. Lots of buying takes place at this level when investors are extremely enthusiastic about the market. It seems like this market will go up forever, and some experience the FOMO effect, the fear of missing out. Then the investment is going to take off, so you better be fully on board. But other people may disagree, start selling out of it, and it goes down. You're hoping the downturn is limited, but it continues to drop. And pretty soon you're back to hope. I hope it doesn't go down, but it does. In fact, it drops so much that your investment is now below what you started at. You're so fearful at this point that you may consider getting out altogether, booking an overall loss, and giving your investment no chance to recover. And should you keep yourself from selling, the cycle just repeats itself. So you go into the investment knowing full well that the secret ingredient is to buy low and sell high, and unfortunately you let your emotions steer you into doing the complete opposite. This is a common experience for many investors, and it demonstrates how an emotional response to volatility and risk can lead to disappointing performance. As advisors, we're here to take on that emotion on your behalf and provide that independent perspective that helps you stick to your original game plan. We expect the ups and downs, and we don't respond with knee-jerk reactions during downtimes. Is there a way to put this volatility to use? The short answer is yes. Now let's review a couple of ways that might help actually make use of the expected market volatility. The first way is called dollar cost averaging. Again, this is not a personal or tag term. You can find this all over the place. What dollar cost averaging is doing is periodic investments as the market goes up and down. Now let's use an example to illustrate how this might work. Let's say you are investing $100 per month. The first time you invest, your stock or mutual fund is at $20 per share, just to pick a random number to work with. You invest your $100, and at $20 per share, you buy 5 shares. Now what happens the day after you invest? If you are a typical investor, the market goes down and just continues to go down all the way past hope and down to fear as your investment in motion. In our example, the share price drops all the way down to $10 per share. But you listen to your financial advisor and you invest another $100. Your $100 this time buys shares at $10 per share, and you purchase 10 shares. Now most people look at this and say, so I bought shares at $20 per share and the next share is at $10 per share, so my average cost per share must be halfway in between, or to $15 per share. But wait, the mathematicians of the group say I invested a total of $200 and bought 15 shares. If I do the math on that, my average cost per share is only $13.33, almost as if I bought all my shares down near the bottom. The system forced me to buy more shares when the price was low and fewer when the price was high, and I didn't have to try to time the market. Now, dollar cost averaging is not a guaranteed money maker. The markets may go up from when you first bought, and dollar cost averaging provided no value. Instead, if you look at the effect of dollar cost averaging over 10 years from now, the effect is typically minor. It is more important to be in the market than it is to try to time the market. Now, wouldn't it be nice if we could find an investment that is counter-cyclical to our ownership investing? When the first investment went up, the second on would go down. Yet, over time, they end up in a similar long-term return. Three American economists won the Nobel Prize in Economics in 1991 by demonstrating that there are investments that operate countercyclically. They called their method modern portfolio theory. We usually refer to it as asset class investing or strategic asset allocation. Another technique that we use with this is to rebalance the portfolio across the countercyclical asset class investments. The idea is that when one of the asset classes has gone up while another has gone down, you would want to sell some of the one that has gone up and buy some more of the one that is down. Note, this does not always work. For example, if you happen to be here where the downward meets the upward line, you just took away from the asset that is going to continue to grow to purchase more of the one that is continuing to go down. Another factor in rebalancing is taxes. If you're selling the asset class that is profitable, you will have to pay taxes. For accounts when taxes are not an issue, for example, an IRA or a pension plan, historically, quarterly rebalancing has been found to be most effective. In accounts where taxes are an issue, usually the strategist will wait until there is a significant percentage difference before making the rebalance. So what asset classes do we use? The three Nobel Prize winning economists came up with 4 sets. The first one is small capitalization, small cap, and large capitalization, large cap companies. The next one is value companies, high book to market, and growth companies, which are low book to market. Now, a growth company is typically one that has done well and is expected to continue to do well, while a value company tends to be one that has had bad news, that has depressed the stock price, or one that has a higher income relative to its stock price. Another one is domestic U.S. stocks versus international stocks. The final relationship that the Nobel Prize winning economists used was equity versus fixed income. Remember that fixed income or bonds typically ends up lower than stocks over time. What we find typically, though, is that when investors grow leery of stocks, they run to the safety of bonds. Please note, as with all these relationships, this countercyclical movement does not always take place. A recent example of this is in 2022 when both stocks and bonds dropped in value. And since the three economists came up with their asset class relationships, current investors have added some other asset classes, such as real estate, alternative investments, emerging markets, and others. Being diversified and being scientifically diversified using asset classes and strategic asset allocation can help provide a smoother ride towards your long-term financial success. Now, Investing 101 tells us that there's a simple formula to being a successful investor. All you have to do is buy low and sell high, and then repeat that over and over. The problem is, and it's a big problem, no one knows when the market is high and when it is low. Now let me emphasize that again. No one knows when the market is high and when it is low. We speak with highly qualified industrial professionals on a weekly basis and hear conflicting opinions on where markets are headed, despite great supporting evidence for their case. There's a plethora of data at our disposal on where markets should go. But if all these practices were a certainty to selling at the right time, everybody would be a millionaire. So what is the best advice that we can give you in this regard? Don't try to time markets. The markets will fool you constantly. We discussed earlier how even in a rock-solid economic environment, investors' emotions can cause corrections and cause people to do the wrong investment actions at the wrong times. So what is a good way to get into diversified investments without a lot of money? Now, many people have access to mutual funds for their investments. Mutual funds are a way for you to pool your investments and hire professional management. Your 401k plan probably only has mutual funds as your investment vehicle. So what are mutual funds? Let's say you want to buy stocks. If you were to buy 100 shares of Amazon, it would run you over $245,000. Not many people can or even want to sink that much into a single stock like that. It would perhaps be more prudent to have a diversified portfolio consisting of various stocks. If we decide to pool our funds together, we can do that. If everyone here were to put in their money all together, we would have a nice pool where we could buy multiple stocks and afford to hire a professional manager to buy and sell the stocks for us. This is what a mutual fund does. It allows us to pool all of our funds and those of thousands of other investors together and have our pool of funds managed by a professional money manager. Some people, when they invest, want to have long-term growth and don't worry about short-term volatility. Others want to have more moderate volatility and maybe more income. Some want to have their money manager just buy bonds, while others want a mix of stocks and bonds. This is why there are so many mutual funds out there. In 2019, there were over 123,000 mutual funds around the world. Each one has different objectives, different managers, different costs, and different rules. You can find all of these attributes outlined in the fund prospectus. Mutual funds have different minimums. You can get started in some funds with as little as $25. Others have much higher minimums, so check the fund that you want. Now, this is an important point. Most publicly traded mutual funds trade at the end of every market day. If you put your order to sell in at the beginning of the day or the end of the day, it doesn't matter. You get the price of the mutual fund at the end of the day. This is in contrast to stocks that fluctuate throughout the trading day. These are very basic fundamentals shown on the screen, but here's how the world really works. First of all, history has provided great evidence that markets go up and markets go down. Since no one can time markets, we need to have a real plan for investing. Now, not all investments are alike. Some are riskier than others. We showed the graph earlier of cash, bonds, and stocks in order of least risk to most risk. Some investments are just more volatile in the short term than others. Other investments may be more stable in the short term but face loss of spending power in the long term. There's no single investment that fits all of your needs. You have to have diversified investments. By diversifying your investments among the difference in a mix that fits your needs and goals, you can help control your investment risks. Also, there is no single investment that is suitable for every investor. This is why we get to know your circumstances, goals, feelings, and risk, and help recommend investments that are suitable for you. So what is the biggest problem that most investors face? Emotion. We alluded to the fact that the most positive economic data and headlines can't overcome investors' emotions. A company could be prospering tremendously, but if the CEO were to get caught in a personal scandal, investors may shy away from that company, sell out of it, and its stock would drop accordingly. Now, if you watched our video on budgeting, you have seen this chart. Getting a head start is an important concept that can help determine your long-term success. One of the main costs in economics is known as opportunity cost. It deals with the opportunities one bypasses by taking action in another. So if you're spending $300 a month golfing, as enjoyable and as happy as golfing makes you, the opportunity cost is what you would otherwise be earning and accumulating should you invest that $300 into preparing for a successful retirement. We're all for enjoying life, of course, but that's simply what the opportunity cost is. Now, a common goal someone may have is to become a millionaire. We've glamorized the term millionaire, but it's certainly achievable. Not just achievable, but perhaps even necessary for a successful and reasonable retirement. If we look at the chart here, the earlier you make these sacrifices, bypass a bit of discretionary spending, and instead direct it towards long-term growth-oriented vehicles, the easier it can be achieved. So if you were to begin at age 20, which is not a small task for a college sophomore or junior, you would need to invest a fixed $285 per month for the next 40 years to reach $1 million in investments by age 60, assuming an 8% annual rate of return. If you do the math, $285 times 12 times 40 is only $136,800. The power of compounding is an amazing phenomenon. Your earnings themselves yield earnings and over time have the potential for such significant growth. So just $136,800 in contributions turned into $1 million. Now, if you get started late, perhaps because you weren't encouraged to invest or didn't have the excess cash flow to get started in such a disciplined plan, let's say you waited until age 30. At this point, you have lost 10 years of potential growth and compounding from our previous example. Here you need to invest $667 per month to reach that $1 million by age 60. This is a factor of nearly 2.5 than if you had started out at age 20 and a grand total of $240,100 in total funding. Now wait until age 40, you only have 20 years to invest and you'll have to put away $1,686 monthly, a total of over $404,000 in funding, and it just gets uglier the longer you put this goal up. So how should you invest? Every single client we meet with and every investor have different needs and circumstances. There's no one-size-fits-all investment out there suitable for everybody. You need to work with your personal financial advisor to set up the portfolio that achieves your goals, meets your needs, and is within an investment program that allows you to sleep at night without worrying about your investments. Developing a successful strategy and a disciplined game plan begins with the completion of a risk tolerance questionnaire. Everybody's built differently, and some respond to the consequences of risk more so than others. This is one of the key factors we use to determine what recommendations are appropriate. We then design a suitable mix of investment selections to work towards your goals, needs, and capabilities. We want to thank you for watching this video today. Now, we've covered a lot today, and due to our limited time, we have had to condense various topics and discussion points. There are many factors to consider before you're able to properly evaluate your situation and determine the most suitable way to work towards meeting your goals. The advisory group is ready to assist you in determining your plan, coordinating it, and getting your path towards financial independence started. Now, those of you who already work with us now, our first meeting is always complimentary, a chance for you to meet us and decide the course of action going forward. We appreciate this opportunity to share some ideas with you and hope that you found this series of videos enlightening and helpful. As you can imagine, we're in a heavily regulated industry and are very mindful of every bit of information that we provide to you, so we have some disclosures here. We realize your investment dollars are hard earned, and so we and the regulators want to make absolutely certain that we provide you as much information as possible when making these decisions. And a second page of disclosures. And here's a third page of important disclosures. And finally, a fourth page of disclosures. Please pause your viewing of the video if you need additional time to read these important disclosures in detail. And should you wish to set up an appointment with us to further discuss any areas of concern, not only based on this presentation, but as they pertain to your financial affairs, please reach out to us on the phone number or email address shown here on your screen. The best person on our tag team to set up a meeting with one of us is Katie Barron at extension 215. Of course, we love it when people learn new information, so should you have any questions, please feel free to contact us. Here's our contact information again on your screen. This concludes our presentation. Thank you all again for viewing this video, and be sure to watch the other 3 videos in this series.